welcome to The Trade. Let's get you caught up on what traders are watching out there. Tesla seeing 20 to 30% growth in vehicle sales next year. Elon Musk reassuring investors the company is improving its core business of selling EVs profitably. Boeing factory workers voting on a new contract proposal that could end a more than 5-week strike. McDonald's scrambling to contain the damage from an E. coli outbreak linked to its quarter pounder burgers. China's currency feeling the pressure from a possible return of Donald Trump as US president, not just from spectators shorting the currency, but also mainland exporters who've been hoarding dollars. And Bank of Japan Governor Ueda saying it's still taking time to sustainably achieve its 2% inflation target. Of course, the BOJ meets next week. Well, Andrew spoke with Jason McIntosh from Motion Trader, delving into some charts to get a better sense of recent movement in markets.
I thought I'd start with an interesting fact. So the last week, the S&P 500 hit its 47th all-time high for the year. And look, I'm sure a lot of people hear that and think, geez, 47 all-time highs, that sounds pretty extreme. And yes, it is a lot, but it's not as extreme as it sounds, because the most all-time highs in a year was 75, and that was back in 1995. Now, people might wonder, well, what happened the next year? Surely the market had to turn down after such a hot run, but that's not what happened. It made 39 new all-time highs the next year and 45 the year after that, and this continued on for several more years. And this is the thing with all-time highs. We get these clusters of them because that's how a trend works. A series of all-time highs doesn't warn of a top, rather it tells us that the market's in an upward trend. And yes, these trends ultimately end, and yes, there's corrections along the way, but the data is currently telling us that the path of least resistance remains to the upside. Just looking at this chart here, we've got rising moving averages. Now I've got the 150-day moving averages on this chart, and we also have the price above the moving averages. And in addition to that, we've got a series of higher highs and higher lows. So all of that is pretty much what the definition of a bullish price structure is. We've seen prices pull back over the last few days. I think there's scope for maybe several weeks of consolidation. Perhaps we see prices come back towards the 50-day moving average. We often see that in upward trends. But at this stage, there's nothing here that's jumping out and telling us we should be changing our game plan from being long equities. While we're on the US markets, there's another chart I want to show you, which I think is always really important to have a look at. This is the S&P 500 on an equal weighted basis, as opposed to the market cap version, which we often look at. And this is actually my preferred measure of taking in the state of the market, because the difficulty we have with the S&P 500 is that the top 3 companies make up around 20% of the index. And if you take the top 15 companies, well, that's about 40% of the index. I think this can make it harder to assess the performance of the broader market. And this is a great thing with the equal weight. It doesn't have those issues because each stock is ranked equally. So what does this chart tell us? Well, unlike the S&P 500, which only broke above its July high last month, the equal weight has been making new all-time highs since August. So from my perspective, this is a sign of broad participation, which is one of those key factors in a healthy bull market. Of course, it's also got those rising moving averages, prices above the moving averages. I think rather than worry about the series of all-time highs this year, I think it's simply a case of continuing to follow the trend. We still need to manage risk, but I think the default position should be stay long equities.
All right, you can't fight that then. So, Jason, that's what we're seeing on Wall Street. Let's come back home then. And how does that compare with what we're seeing on the ASX 200?
Yeah, so the ASX 200, a new all-time high on Thursday, and now we have this quick reversal of last week's rally. There's often a tendency, I think, to worry about market tops in these situations. We see an all-time high, and then we get a quick pullback. But more often than not, the best course of action is to view pullbacks as temporary pauses within an ongoing trend. And that's because the uptrend typically leads to further strength. Now, that may not be tomorrow, it might not be next week, it might not even be next month. But these big trends, they're powerful forces, and they really can last for longer than many people anticipate. Just looking at this chart of the ASX 200, It's had over half a dozen pullbacks so far this year. The longest was between April and July. There's also a shorter, sharper pullback, which we saw in August. But all these do the same thing. What they're doing is they counterbalance, they act as a counterbalance for an uptrend and consolidate those earlier gains. When we consider the underlying chart structure that we can see here, the ASX 200 has got those rising 50 and 100-day moving averages, prices above the averages, and we can see a series of higher highs and higher lows. So the default position should be that this remains a bullish market. I think the quick reversal of those gains we've seen just in the last few days, I think that hints at more consolidation ahead. I think the best scenario here would be maybe for some consolidation above support at around 8,100. You can see that blue horizontal line towards the top right of the chart. This also coincides with around where the 50-day moving average is. They're typical points where you can get consolidation. While we're on the local market, one more chart I want to have a look at, which just comes away from the big stocks in the ASX 200. This is the ASX Emerging Companies Index. And smaller companies are also a really good way, I think, of getting a gauge for the underlying health of the market. And when we look at this, I think the overall structure here is bullish. So firstly, you'll see down the bottom of the chart that blue arcing shape. So it's a rounding base formation. And this is where you get a series of lower lows towards the left-hand side of the curve, and that turns around and becomes a series of rising lows. And we often see these around important market bases. And also looking at this, the moving averages are positive, prices above the averages. So we've got that underlying bullish framework. But if you just look at the rally, think about the rally we've had off the September low. And it's been such a strong rally, about 14% in about 5 weeks, almost uninterrupted in terms of like just day in, day out. I think there's a good chance we do get a pullback after such a strong run, maybe back towards those moving averages or sideways, letting those moving averages catch up. And that would fit with that consolidation scenario for the ASX 200. My strategy here, Andrew, I think it's all about staying long. It's using wide trailing stops to try and see off pullbacks when they happen. And the beauty of the trailing stop is it does get you out when the trend inevitably does end. It's one of those risk management strategies, I think, which is a must for anyone actively managing a portfolio.
Jason McIntosh there. That does it for this episode of The Trade. Be sure to join us next time.